They waited. They watched the calendar. They counted down the hours until the biggest buyer in the world turned off the lights and went home for the holidays. And the moment the Shanghai Gold Exchange closed its doors for the Lunar New Year, they struck. If you are looking at your screen right now, you are seeing a sea of red. You are seeing silver smash down to $76.28. You are seeing gold lose the psychological handle of $5,000, trading down at $4,977. You are seeing the headlines scream that the rally is over, that the momentum is dead, and that the bears have taken control. But you need to stop. You need to take a deep breath. Do you know what today is? It is the eve of the Year of the Horse. It is the start of the Golden Week in China. Key markets in the Eastern Hemisphere, the engine of global physical demand, are currently offline. The factories in Guangdong that consume silver for solar panels are closed. The jewelry shops in Hong Kong are tallying their inventory. The massive trading desks in Shanghai that have been driving the arbitrage price are empty. The dragon is asleep, and the mice are playing. As what we are witnessing today is not a market crash. It bears all the hallmarks of a holiday raid. It appears to be a calculated tactical liquidity event designed to exploit the absence of Chinese buyers. They know that when China is closed, the floor under the silver price is temporarily removed. They know that the volume is thin. They know that a few thousand paper contracts sold on the Globex Open can push the price down $4 in a matter of minutes because there is nobody on the other side of the trade to absorb the selling pressure. This is a recurring pattern observed in historical market cycles. If you go back and look at the historical data for the last 10 years, you will see this pattern repeat over and over again. When the East goes on holiday, the West smashes the price. Why? Because the data suggests a rush to cover short positions before the buyers return. There is an apparent effort to paint the charts red, potentially shaking confident holders out of their positions. They want you to believe that the fundamentals have changed. But have they? Ask yourself a simple question. Did the solar factories stop needing silver today? No. Did the debt crisis in the United States get solved over the weekend? No. Is there any sign central banks stopped buying gold? Unlikely. The only thing that changed is that the Shanghai Futures Exchange is closed for a few days. This appears to be the primary catalyst for the drop. And surrendering your physical position because of a calendar event is exactly the reaction the institutional algorithms are programmed to trigger. You're giving them exactly what they want. Cheap silver to restock their empty vaults before the momentum potentially shifts back to the upside. We need to dig deeper into the specific mechanics of this drop because it tells us a lot about the desperation of the cartel. We saw the price of silver smash down $4 on the opening candle of Globex. That is not natural price discovery. That has the appearance of a market order dump. It resembles large-scale selling with little regard for the price, specifically to trigger stop losses. It looks like a hunt. It appears the market is targeting the stop-loss orders of retail traders who bought the top last week. They are trying to flush out the leverage. This illustrates the dangers often discussed in this market. It highlights why leverage is frequently cited as the enemy. If you are trading with borrowed money, today was a painful day. You likely got a margin call. You likely lost your position. But if you are a stacker, if you hold the physical metal, the ounces in your safe did not disappear. The weight did not change. The only thing that changed is the paper price tag that the futures market is assigning to your wealth. And while the Western banks are playing games with the paper price, the Chinese government is doing something that should terrify anyone who is short this market. We are tracking significant developments regarding the silver fund in China. While the price is dropping in New York, Beijing is stepping in to protect its investors. We have reports that China is looking to restabilize its major silver fund. More importantly, intelligence suggests they are preparing significant policy support to protect domestic holders. We are hearing rumors of a state-backed stabilization initiative launching later this month to counteract the volatility. Think about what this means. In the West, when sharp volatility hits the price, regulatory intervention is rarely seen. They say, it's a free market, and they let the retail investor get slaughtered. In the East, the government is actively intervening to support the silver investor. They are effectively placing a state-sponsored floor under the market. They are saying, we value this asset. We value the people who hold this asset, and we will not let the Western manipulation destroy their wealth. This is a massive signal. It tells us that China views silver not just as a commodity, but as a strategic monetary asset. They are building a firewall around their silver market. And when the market reopens after the Golden Week, do you think the Chinese investors will be selling? No, they will be emboldened. They will know that their government has their back. They will buy the dip with both hands. So, for the disciplined stacker, the drop to $76 is not a crisis, it is an opportunity. It may be viewed as a temporary discount created by a holiday. But we have to be careful. We have to respect the technical damage on the chart. The drop has broken some short-term support levels. The momentum indicators have turned negative for the moment. We are currently trading in a dangerous vacuum. With China closed, there is very little support below us until we hit the $74 level we discussed in our last report. It is entirely possible that the manipulators will try to push the price even lower this week. They might try to test the resolve of the market at $72 or even $70. If that happens, it is crucial not to panic. It is crucial not to let emotions take over. You have to look at the macro data. You have to look at the bond market. While you were watching the silver price drop, did you see what happened to the U.S. Treasury market? Did you see the latest data on China's holdings of U.S. debt? This is the real story. This is the story that Bloomberg and CNBC are trying to hide with their scary red charts. China is rapidly exiting the dollar system. Reports suggest China continues to sell off U.S. bonds aggressively. Estimates place their current holdings significantly lower than historical averages. That is the lowest level since 2008. Let that sink in. The lowest level in 18 years. For 2 decades, the global financial system relied on one simple mechanic. The U.S. prints dollars, buys cheap goods from China, and China takes those dollars and buys U.S. Treasury bonds. It was a cycle that kept interest rates low and the dollar strong. That cycle is dead. China appears to be moving away from recycling its surplus into dollars. They're dumping the dollars. And what are they buying instead? Gold. China's gold reserves have been increasing for 15 consecutive months. They have reached a new high of $370 billion in official reserves. And that is just the official number. Many analysts speculate that the total number, including off-book holdings by sovereign entities, could be significantly higher. They are swapping paper promises for hard assets. They are moving away from currencies that are subject to geopolitical risks or monetary expansion for an asset historically viewed as having minimal counterparty risk. So, when you see gold drop to $4,977 today, do you think the People's Bank of China is worried? No, they are laughing. They are likely using this drop to buy more. They are exchanging their dying bonds for cheap gold. This is the Great Rotation. It signals a potential structural shift in the global currency regime. And days like today, where the paper price disconnects from the physical reality, are simply opportunities for the smart money to accelerate that rotation. But there is a ticking clock that we need to talk about. There's a specific date on the calendar that matters more than any price target. It matters more than any technical indicator. It is a date that demands significant attention from the banking sector, February 27th. This is first notice day for the March silver contracts on the comex. We are exactly 10 days away. Why does this date matter? Because right now there's a massive imbalance in the market. The open interest, the number of paper contracts that are active for March, is standing at a staggering 294 million ounces. That represents paper contracts potentially controlling nearly 300 million ounces of silver in less than 2 weeks. Now, look at the other side of the ledger. Look at the registered inventory in the comex vaults. These are the bars that are actually available to be delivered. That number has fallen to roughly 90 million ounces. Do the math. 294 million ounces demanded, 90 million ounces available. There is a deficit of over 200 million ounces. Now, in a normal month, this wouldn't be a crisis. In a normal month, the banks would simply pay the traders in cash. They would say, here's your profit, go away. And the traders, who are mostly speculators, would take the cash and run. But this is not a normal month. The premium in Shanghai is still massive. The physical shortage is real. The industrial users, the solar companies, the electronics manufacturers, they don't want cash. They can't build a solar panel with a paper dollar. They need the metal. If even half of those contracts stand for delivery, if just 150 million ounces are demanded, the comex infrastructure would face a historic test. There are doubts whether they could physically fulfill such orders. They might be forced to declare a force majeure. They might be forced to admit the system is under severe strain. This is why they are smashing the price today. This is why they appear to be using the holiday liquidity to drive the price down to $76. They're trying to scare the longs out of the market before February 27th. They want you to close your position. They want you to sell your contract. They want to reduce that open interest number from 294 million down to something manageable, like 80 million. They are fighting to maintain market stability. Every dollar they drop the price is an attempt to force a margin call on a trader who is demanding delivery. It is a game of chicken. The banks are pushing the market to its limits, hoping the speculators exit before the delivery deadline. But what if the passengers don't jump? What if the maximum stress scenario plays out? We have 10 days to find out. 10 days of psychological warfare. 10 days of volatility. 10 days where they will use every trick, every spoof, every fake headline to get you to sell. The drop to $76 could be just the opening salvo. They might push it to 75. They might push it to 74. But remember the math. The price on the screen does not create more silver in the vault. The lower they push the price, the more physical metal leaves the system. In the next part of this report, we are going to dive deep into the specific data coming out of the Chinese base metal market. We are going to look at the explosion in nickel and tin trading on the Shanghai exchange and why this retail mania is about to spill over into silver the moment the holiday ends. We are going to explain why capital appears to be rotating out of the property market and aggressively accumulating commodities, and how this wave of capital is set to collide with the Western bank shorts in the very near future. Stay with us. The context is everything. And the context tells us that the dragon is just taking a nap, and when it wakes up, it is going to be very, very hungry. And hungry is an understatement. If you want to understand the scale of the appetite building in the East, you have to look beyond silver for a moment. You have to look at what the Chinese retail investor is doing with their money right now. While the Western media focuses on the stock market and the latest tech bubble, a quiet revolution is happening in the commodity pits of Shanghai. Confidence appears to be waning in traditional savings vehicles like real estate and the stock market. The property sector is still navigating a prolonged and complex downturn. The Shanghai Composite is volatile and unpredictable. So where does the money go? It flows like water into the only asset class that feels real. Commodities. We are reviewing data from the Shanghai Futures Exchange that is quite remarkable. In January alone, the combined trading volume for aluminum, copper, nickel, and tin futures jumped by 86% month over month. That is 78 million lots traded in a single month. To put that in perspective, that is 5 times the average monthly volume seen in the first 11 months of 2025. It is a tsunami of capital. It appears to be a rapid rotation out of financial derivatives and a significant move into hard assets. Look at nickel. The trading volume exploded by 300% in December, 30 million lots. Look at tin. The reported volume recently hit levels that dwarf the typical annual physical usage of the metal. Think about that. In a single session, trading volumes represented a supply quantity equivalent to multiple years of global demand. This is not normal market behavior. This is a mania. This is a public that appears highly motivated to own tangible assets. And it is being driven by social media, by online communities, and by ordinary investors who are concerned about inflation and currency trends. Now, ask yourself, what happens when this wave of capital crashes into the silver market? Silver has historically held a status similar to people's money in Chinese culture. It has a cultural significance that goes back thousands of years. It is cheaper than gold and more accessible than nickel or tin for the average person. When the Shanghai Futures Exchange reopens after the Golden Week holiday, do you think this crowd is going to ignore silver? Absolutely not. They are going to pour into it. They are likely to view the dip to $76 as a major accumulation opportunity. They may interpret the government's stance on the silver fund as a supportive signal. And history suggests they will look to acquire more. This is why Western financial institutions are on high alert. They recognize the momentum shifting. They know that once the holiday ends, the retail army in China is going to return to their screens with fresh capital and a mandate to buy hard assets. The institutional shorts have a very short window, literally just a few days, to manage their exposure and cover positions before the wave hits, and they are utilizing every available mechanism to stabilize the market. They are raising margin requirements. The Shanghai and Guangzhou exchanges have reportedly tightened trading rules numerous times in the last 2 months to try to contain the speculation. They are trying to cool it down. But it is challenging to cool down a market driven by an urgent flight to safety. It is difficult to stem capital flows when the alternative is a distressed property sector. This retail mania is the wild card that the algorithms in New York cannot model. The algorithms understand interest rates. They understand technical support levels. But they may not fully account for the psychology of a vast population seeking alternatives to fiat currency. And this brings us back to the specific mechanics of the silver market and the ticking clock of February 27th. We mentioned earlier that the exchange is facing potential inventory tightness. Now let's break down the numbers again because they are critical. The open interest for March silver is roughly 294 million ounces. These are contracts where the holder has the right to demand physical delivery starting on first notice day. The registered inventory, the metal that is actually sitting in the vault, ready to be handed over, is down to roughly 90 million ounces. Now, the skeptics will say, but most traders don't take delivery. They just roll the contract forward or settle for cash. That is true in a normal market, but in a market where the physical shortage is acute, where industrial users are desperate, and where the premium in Shanghai is $7 higher than New York, the incentive to take delivery is massive. Market participants may question the value of cash settlement when significant price disparities exist between physical delivery and regional spot prices. The arbitrage spread is historically wide. It presents a massive incentive for anyone with the logistics to move the metal, and the banks know this. They know that the smart money is positioning to drain the vaults. That is why we are seeing such aggressive price suppression right now. They are trying to make the long trade painful. The market volatility tends to shake out speculative positions, but look at who is holding the strong hands. It is the industrial users. It is the sovereign wealth funds. It is the entities that actually need the metal. They are not going to fold because the price dropped $4. If anything, they are going to increase their orders. And then there is the geopolitical angle. We cannot ignore the drums of war. The tensions in the Middle East are escalating. If the oil supply is disrupted, the price of energy skyrockets. And since mining silver is incredibly energy intensive, the cost of production goes through the roof. Inflation pressures could surge, putting the dollar under severe strain, and gold and silver become the only safe haven left. Regional powers have been strategically preparing for such scenarios for decades. If key maritime routes are blocked, if the supply lines are severed, the global financial system faces a potential freeze. The derivatives market, heavily leveraged on paper, risks seizing up. And physical commodities you can hold in your hand may become the preferred store of value. This is the black swan event that nobody is pricing in. The market is acting like everything is fine. The stock market is near all-time highs. But institutional investors are hedging. They are accumulating gold at current valuations. They are buying silver at $76. They are preparing for the worst while hoping for the best. So when you look at the chart today and see the price down, many experts suggest looking beyond the red candles. They see it as a divergence. The paper price is going down because of a holiday liquidity gap. The fundamental value is going up because of physical scarcity, Chinese demand, and geopolitical risk. The gap between price and value is where the contrarian investor looks for opportunity. In the next part of this report, we are going to look at the specific danger zones for the week ahead. We are going to analyze the technical levels that market watchers believe are key to the current trend. We are going to discuss the possibility of a washout down to $74 or even lower, and why that would actually be the most bullish signal of all. We will also look at the Silvergeddon scenario in more detail. What actually happens on February 27th if the exchange faces a critical delivery crunch? What happens if they change the rules and force cash settlement? How will that impact the price of your physical stack? The answers might surprise you. Because in a default, the paper price becomes irrelevant. The real price, the street price, detaches completely. And that is when a historic shift in market value likely begins. Stay focused. Maintain your perspective despite the market volatility. We are 10 days away from the moment of truth. And the moment of truth is not just a catchphrase. It is a mathematical inevitability. When the paper price detaches from reality, we enter a phase of the market that very few people are prepared for. We enter backwardation. We enter a world where the spot price becomes meaningless because you simply cannot buy physical metal at that price. We have to talk about what actually happens if the comex defaults or forces cash settlement on February 27th. This is the Silvergeddon scenario that everyone whispers about but nobody explains. Let's say you are a large industrial user, maybe a solar panel manufacturer or an electronics giant. A person bought a March futures contract because he needs silver to keep your factory running. He paid the paper price, let's say $76. The contract says he is entitled to delivery of 5,000 ounces of silver. February 27th arrives. He submits your notice for delivery and sends his trucks to the vault. And the vault manager says, "I'm sorry, we don't have the metal. We have invoked force majeure. Here is your $76,000 back in cash." Now you have a problem. You have cash, but your factory needs silver. He cannot melt down $100 bills to make conductive paste for solar cells. You have to go into the open market, the real physical market, and find silver. But where would he go? Critics argue the comex is effectively empty. The London vaults are reportedly drained. In this scenario, the Shanghai exchange is trading at $83 and rising fast because they know you're desperate. So he goes to a private dealer, he goes to a refinery, and he says, "I need 5,000 ounces right now." And the dealer says, "Sure, but the price isn't $76. The price is $100. And there is a 3-week wait. This is how the price explodes. It doesn't happen on the futures chart first. It happens in the physical premiums. The paper price might still show $76 on CNBC, but the real price to actually get metal could be 50% higher. We saw a preview of this in the nickel market a few years ago. We saw it in the palladium market. When a physical shortage hits, the price can go vertical. It often gaps up overnight. And this is why we suggest that a drop to $76 or even $74 may be irrelevant to the long-term holder. If you own physical silver, you own the asset that cannot be defaulted on. You own the insurance policy against the paper system breaking. Now, let's look at the danger zones for this week. We have to be realistic. The bears are in control of the short-term momentum. The holiday liquidity is thin. They could try to push the price lower to hunt for stops. The first major support level is $75. If we break $76 decisively, the algorithms will target $75. This is a psychological level. It is a round number. A lot of retail traders will have their stop losses sitting right below it. If 75 breaks, the next level is the line in the sand at $74. This is the level that held during the crash last week. It appears to be the bottom of the right shoulder of our bullish pattern. If we close below $74 on a daily chart, the technical damage would be significant. It could open the door to a retest of the $64 lows. But remember, a technical breakdown on low volume during a holiday is often a bear trap. It is likely a false signal. Experienced traders anticipate that the real buying will return next week when China reopens. So they might let the price drift down, let the bears get confident, and then rip the carpet out from under them the moment Shanghai comes back online. We also have to watch the gold price closely. Gold is the leader. Silver is the follower. Gold is currently fighting to reclaim the $5,000 level. It is trading just below it at $4,977. If gold can bounce back above $5,000 this week, it should act as a massive tailwind for silver. It would signal that the safe haven bid is still there. It would suggest that the central banks are buying the dip. And speaking of central banks, we cannot ignore the geopolitical wildcards. We mentioned the Strait of Hormuz earlier, but there's another flashpoint. The conflict in Eastern Europe is escalating. The rhetoric is getting hotter. The sanctions are getting tighter. Historically, when the geopolitical temperature rises, the demand for gold and silver tends to increase. Investors get nervous. They want safety. They want assets that don't depend on the stability of the global banking system. So, while the short-term price action is ugly, the long-term drivers are stronger than ever. The debt is still growing. The wars are still expanding. The physical supply is still shrinking. And then there is the X factor, the thing that nobody is talking about. The U.S. elections are coming up later this year. The political uncertainty is going to be off the charts. Both parties are going to promise massive spending. Both parties are going to print money. Neither party has a plan to balance the budget. This means inflation is baked into the cake. It seems completely unavoidable. Whether it is 5% or 15%, the purchasing power of the dollar is going down. And that suggests the price of everything priced in dollars, including silver, is likely to go up. So, how do we navigate this week? How do we survive the holiday raid without losing our minds or our money? First, we strongly suggest avoiding leverage. I will say it again. We believe trading futures or options on margin this week is dangerous. The volatility is too high. The liquidity is too low. You are gambling in a rigged casino. Second, if you are looking to buy physical metal, this dip is an opportunity. If you can find silver at $76, spot price plus a reasonable premium, many long-term investors would call that a strong accumulation level. You appear to be buying below the cost of production for many marginal mines. You are likely buying below the price that China is paying. Third, watch the news coming out of China closely. Watch for any announcements about stimulus. Watch for any updates on the Silver Fund compensation plan. Watch for the trading volumes on the SHFE when it reopens. If we see massive volume and a price gap up in Shanghai next week, that could be the signal that the correction is over. That would likely be the confirmation that the holiday raid failed. In the final part of this report, we will wrap everything up with a specific action plan for the next 10 days leading up to February 27th. We will give you the key price levels to watch, key specific news headlines to filter out as noise, and the mindset you need to have to hold through the volatility. We will also discuss the possibility of a fake out rally followed by another smash, and how one might spot it before it happens. Because the banks are not going to give up easily. They have billions of dollars at stake. We expect them to fight dirty until the very last second, but they cannot fight math. They cannot fight physics. And they cannot fight a world that is waking up to the truth about sound money. Stay with us. The final countdown has begun. This brings us to the end game. We have analyzed the holiday raid. We have looked at the empty factories in China and the low-volume algorithmic churning while New York is closed for the holiday. We have analyzed the aggressive strategy by Western institutions to use a calendar event to pressure the price of silver down to $76. But now we have to look forward. We have to look at the next 10 days. Because the window for this manipulation is closing. The dragon does not sleep forever. And when China wakes up, the math takes over. We need to talk about the Alipay signal one last time because it is the key to understanding the geopolitical chessboard. We mentioned in part 1 the persistent reports that a compensation initiative for silver investors is being staged via an Alipay mini program. Do you know when that program is rumored to launch? February 26th. And do you know when first notice day is for the comex silver delivery? February 27th. Do you think that is a coincidence? Do you think it is an accident that the Chinese government is stepping in to stabilize and support its silver investors exactly 24 hours before the Western banking system faces a potential delivery squeeze? There are no coincidences in markets this large. This is a coordinated move. China is shoring up its domestic market. They are making sure their citizens are whole. They appear to be preparing so that if a squeeze occurs, their people are holding the bag of silver, not the bag of worthless paper. They're preparing for the break. And this brings us to the action plan for the next 10 days. We are in the final countdown. The open interest on the comex remains at historically critical levels. The registered inventory remains tight relative to potential claims. The leverage ratio remains critically high. Every single day between now and February 27th is going to be a battle. The banks will try to smash the price again. They might try to push it to $75 tomorrow. They might try to catalyze a sharp sell-off later this week. They are under immense pressure. The window is narrowing. They need to close those contracts. So here is the strategic outlook. Here is how you survive the Silvergeddon countdown. Point number 1, look beyond the spot price. I know this is hard. I know you want to check your phone every 5 minutes. But for the next 10 days, the price on your screen is a distortion. It is a synthetic price derived from paper algorithms trading in a holiday vacuum. It does not reflect the value of the metal. If you see silver drop to $74, understand the mechanism behind the move. If you see it spike to $80, do not get euphoric. It is just noise. The real price is what happens after the delivery notices go out. Point number 2, watch the open interest. This is the only data point that matters right now. You can find this on the CME Group website. Watch the open interest for the March silver contract. If that number stays high, if it stays above 150 million ounces as we get closer to next week, then the pressure is real. If the banks cannot convince traders to close their positions, a squeeze becomes highly probable. Point number 3, hold fast to your insurance. If you own physical silver, you own insurance against a currency collapse. You own insurance against war in the Middle East. You own insurance against a banking crisis. Why would one surrender their insurance policy right when the house is starting to smell like smoke? The drop in price is designed to make you sell. Do not let them shake you out of your position. Point number 4, acknowledge for the black swan. We touched on this earlier, but we cannot ignore the reports about the Strait of Hormuz. Current geopolitical analysis suggests that regional tensions could escalate in the coming weeks. If a major naval asset is compromised, or if the oil flow stops, the financial world changes overnight. The algorithms selling into thin liquidity today could be forced to cover at much higher prices tomorrow. You cannot time a black swan event, you can only be positioned for it before it happens. And finally, point number 5, understand the wealth transfer. We are witnessing a historical shift. For 50 years, the West has exported inflation to the East in exchange for cheap goods. We printed dollars. They sent us toasters and TVs. That deal is over. China is pivoting away from buying our debt. They are buying gold. They are buying silver. They are buying copper. They are moving from vendor to owner. And the Western banks are trying to stop them. They are trying to suppress the price of these assets to keep the dollar system alive for just a little bit longer. But they are running out of ammo. They are facing a significant tightening of available physical inventory. So, when you see the red candles on your chart today, realize what they are. They are the desperation of a dying system. They are the symptoms of a leveraged system that is running out of liquidity. The drop to $76 is not a defeat. It is a confirmation. It confirms that the market tightness is so severe that they have to pressure the price during a holiday just to maintain control. You are on the right side of history. You are holding the asset that has survived every empire, every war, and every currency collapse for 5,000 years. Do not let short-term volatility obscure the long-term thesis of wealth preservation. Stay physical. Keep your eyes on the horizon, not the ticker. The dragon is waking up soon. Subscribe.